Name and shame the pension fund. On Tuesdays, we're going to start a new series where every Tuesday we'll go through a name and shaming of a particular pension fund. We're going to start off with St. James's Place Polaris 4 and do a deep dive analysis of this and why it fails the pension test. Now, it's marketed really well as a neat, balanced solution and a sort of velvet glove service. Okay, there's a problem with it. Is the complaints I get from people is it's not delivering growth and it's got relatively high fees. It's supposed to be a middle of the road kind of option, the one where you would think to yourself, yeah, okay, I'm not sure whether I'm high risk or low risk, I'll just go with this. And that's obviously what the IFAs have relied on. The problem is expensive marketing has duped people. Let's have a deep dive into this. The premise is two products: the marketing, the wrapper, solid, balanced pension solution. Who wouldn't want that? Trust net classification, mixed assets, 40 to 85% shares seems about right. Got a bit of cash, won't drop too much, surely, but lots of equity exposure. It's not going to deliver though, and we'll take the lid off and you'll see exactly why. Okay, again, the vibe here with the marketing is pre-packaged, neat, middle of the road, simple, can't go wrong, not too extreme on one side, not too cautious on the other. The marketing, fine. The delivery, not so good. Let's look at the reality and the engine on this one. First of all, it's equity heavy on fund of funds. Now, equity heavy, fine. You're invested in stocks, so you think to yourself, oh, I've got lots of exposure to NVIDIA or any other high growth company. You haven't. It's a fund which invests in other funds, which then invest in other stocks. So by the time you get to the individual stock that you hold, you're holding quite a small amount. So any gains that stock makes won't be that great. There's further problems, and we'll return to that last problem that I just mentioned in a moment. Yes, you can hold up to 100% equities. Sounds great. The reverse of that is in years like 2022, when you should not be holding any, got too excited then, any equities, and you should be holding cash, they can't do that. They predominantly stay 80% in shares, not a problem as long as the shares they hold are sufficiently concentrated and we've got a growth period. The problem is they're not doing it directly. They're doing it through a fund of fund structures. And when you're going to need to be in cash, they can't do it because it's not within the remit. And no IFA is going to tell you time to get rid of your Polaris. Okay, so you've got high beta. What's high beta? Beta means it just mimics the underlying benchmark it's supposed to be copying. The problem with that is you're not generating what's called alpha. You're not outperforming. You're just mimicking or index hugging. So what happens with a lot of these funds is they find a benchmark and then they look at what the components of the benchmark are and they add a bit more of one and a little bit of the other. So they gamble on one or two equities, outperforming one or two, underperforming. You think with their expertise that would work out well. Eugene Fama, the Nobel Prize winner, proved that that actually isn't going to work out well for people at all. And so did Warren Buffett as well. So you're just an index hugger without getting index returns. You're underperforming the index because you've got layers of fees upon fees. Let's have a look at a bit more of some of this. Audit point 1, the risk reality, the asset allocation. Okay, red flag number 1. Can allocate up to 20% in unregulated collective investment schemes. We've seen many disasters where that's happened. Unregulated collective investment schemes. Look, if people are thinking they're getting Microsoft, Apple, Costco, Walmart, JP Morgan, Goldman Sachs, and you're going into something completely different, that's worrying. It's not a defensive strategy. The fund is structurally designed for high equity exposure. That's fine, except the growth is not being delivered. You don't mind getting high equity exposure if you're going to get high equity type returns. You're not getting them because, as I've said before, you're going through layers of funds and putting too little money in the high growth companies. The allocations to unregulated vehicles adds a layer of complexity, liquidity risk, real absolute mess. If people wanted that, they'd do it. Don't just rely on the clever marketing to think, oh, it's okay. They know what they're doing. It's not liquid, therefore not good. Audit point 2, the fee stack. Okay, you've got the fund stock, and then you've got the ongoing advice, the product charges. You've basically got a whole load of bundled charges within them. St. James's Place, renowned for this, the initial haircut, right? Before investment begins, initial advice fees are deducted. Now, these can vary and they change all the time. In St. James's Place, as soon as somebody points it out to them, they keep changing it. So don't be surprised if by the time I've even broadcast this, they've now changed it yet again, just so they can see how much they can hide below their various layers. That's my concern. That's my opinion. That's supported by the data. So on a 500k contribution, okay, you're looking at £12,500 getting lobbed off. All right, they will give you all sorts of caveats as to why that might not be the case and how they unbundle things. And just because they show you where it's all coming from, you shouldn't worry. But here's the problem of the wealth erosion and what the price of the velvet glove is. If you did your own SIP, your own pension, okay, which you can do with any broker, but people are just too scared. And yet the wealthy people who read the Sunday Times and the Sunday Telegraph are doing it all the time, so they can manage. That's your gap. Those are the numbers. Just take that in. Those small fee gaps add up to a hell of a lot of money. And that's before the growth you can get by directly investing in equities yourself anyway. And before somebody tries to scare you away from that, SIPs and ISAs were created so you could make direct investments. Of course, you need knowledge and data. That's where alpeshpatel.com comes in, free, okay, to give you the knowledge. And I've written 18 books for the Financial Times on exactly this for that reason. Audit point 3, the liquidity trap, the 2036 horizon, let's put it that way. Okay. You've got all sorts of lock-ins and fees and oh, God knows what. Now, I've tried to understand St. James's Place as much as I can through reading all the materials and what happens if you withdraw early and all sorts of things. What if you started sooner and how long are you locked in? Oh my word. Okay, basically, every time I look at something, it looks like lock-in and you're screwed. Now, there's no reason for that, because if I want to sell Microsoft in a SIP, I click a button and I've sold it. I'm out of it, exited. But you try and exit one of theirs, I don't know why they're handcuffing you, because they're investing in illiquid assets. They want to lock you into some of those illiquid assets. By liquidity, we mean things you can exit really quickly, stocks. Illiquid means private investments, things that you can't. Audit point 4, pedigree versus scale. Now, St. James's Place gets bad press and then creates a whole bunch of new products. So those new products don't have time to get bad press, and then they'll do it again. So they've not had a full market cycle, because guess what? They launched it at the end of 2022. Now, unless you've survived, or you can at least look at your existing investments and say, what would they have done in 2022 or 2008 or 2000 based on the volatility of your portfolio? And we make those tools freely available to students, to clients, to public. Go to campaignforamillion.com/tools, all free. We don't even ask for your email address. Okay. Then you can see, well, if volatility of my portfolio, say 15%, which is typical, what would it have done in those historic periods? They don't do that because they haven't been through them. So you've got a problem. They're great at distribution. That's why they've got billions under management. But do not be fooled into thinking that just because a lot of people are with them, they must be good. That's a common mistake people make in life, actually, generally. Audit point 5, the red flag dashboard, data from SJP's own value assessments. Well, I'm afraid so many of their funds just fail based on value for money, based on the fact that advice fees are too high, they're not delivering in performance, a whole host of red flags, time and time again with St. James's Place, and it's not changing. So you're getting a Harrods price for basically supermarket ingredients. Okay, Polaris 4, it's a basket of iShares and State Street building blocks, which then themselves invest in stocks. So you've got a premium markup, okay, and you got a fee drag, and the performance is poor because two main reasons. By the time they've got those individual investments, there's little money going into them, or little percentage of your own portfolio. It's not bespoke to you. That's another problem. So you've got your fees, you've got your underperformance, and you can't go into cash in years like 2022, which they've avoided in their documentation because they made sure they did a new marketing pitch with a new set of funds in 2020 after 2022 was pretty much over. So they've just had a bull market run, and they'll market off the back of that. That's the problem with these kind of companies. So stop relying on marketing and start relying on arithmetic. Check the fee stack, it's high. Calculate the erosion it means for you, it's bad. Seek independent advice. Well, guess what the problem with independent advice is? Are going to shove you into funds which are similar to the Polaris fund. All the other ones make the same thing. The only real way you're going to be able to do it is learn for yourself how to start your own SIP, like all those Sunday Times and Sunday Telegraph readers and the high net worths, who basically get rid of all those middlemen, get a little bit of education for themselves. It's free at campaignforamillion.com, okay? And they do a bit of it themselves instead of paying away fees when they really don't need to. I hope that's helped. If it has, feel free to drop me an email. We've got free calculators. How much do you need to retire? What can you retire with 500,000? What age can you retire if you've got 100,000, 200, 300? All those tools are on campaignforamillion.com, and they're all free, and they're going to be free forever. And I don't mean free for a minute and then you got to pay. I mean, you can play around with them, play around. We spent a fortune developing those tools so that you could access them, because we're fed up of adverts from places like St. James's Place and Fisher saying, how much do you need to retire? Can you afford to retire with 500K? Well, actually, our calculators, which are more sophisticated than the calculators they have, actually do all the answers for you for free. Okay, so do that. And if you want a free pension review, completely free educational pension review, then go to campaignforamillion.com and you'll see a link there for that as well. And we'll do that for you as well. I hope all of that's been helpful and useful. It's been my life's mission through all my books, my Financial Times columns, my Bloomberg TV shows, to make sure we make these things available to you so that you can learn for yourself and be better informed and more empowered to make more money for yourself. It's as simple as that. Thank you all very much.